Hello everyone, welcome back. Today I'm going to talk to you guys about my coronavirus investment plan. Okay, I know it's a funny, stupid, silly name for a video, but you know what? We're in really funny, stupid, uncertain times, so I think it's very fitting. Okay, so anyway, before I get too deep into an investment strategy, okay, and by investment strategy I mean investment for survival, okay, not just investment to get rich or to for a retirement plan. I mean investment, in terms of survival. Okay. Before I get too deep into it, I want to talk to you guys about the typical market cycle. Okay, so a typical market cycle looks something like this: it goes up, it hits peak, comes down, maybe about 50% of the way, goes back up. Starts off slow, then basically goes up really fast, and then comes back down. So that's your typical market cycle. And what's usually happening here is, like, you get a market, right? Not when I say market, I mean an economy. You get an economy that builds up some steam, and then it gets to a point, okay, when you get to this point over here where it's kind of peaking, what's happening is that you enter an inflationary period, because what's happening is when everybody knows that the economy is doing really well, basically everybody starts jacking up their prices. Everybody starts asking for raises, and basically people get raises. People get higher prices for goods that they're selling because there's more money floating around. So, and what happens is we enter this inflationary period, and what usually happens is the Federal Reserve comes in. They don't feel very comfortable with this inflationary period, and what they do is they put the brakes on the economy. And the way they do that is they usually raise interest rates. Okay, so they start raising interest rates. And it usually, economies are kind of like freight trains. You can't stop and start them on a dime. It takes a long time for them to pick up speed. And then, if you want to slow it down, it takes a long time to slow it down. And you really don't know how much brake pressure to apply when you have something that big that's moving forward. So what usually happens is the economy starts going up. The Federal Reserve doesn't really like it. They don't feel very comfortable with it, and they start raising interest rates at small increments. Okay, they raise interest rates like a quarter percent point. The economy doesn't respond. They raise it again next month, nothing. They raise it again the following month, nothing. And then what happens is, let's say the third or fourth or whatever, seventh time, they raise interest rates a little bit more, and then all of a sudden, the market basically starts plunging. Okay. And now all of a sudden they're like, oh, we went too hard, we went too far. So, and then what they usually start doing is they start lowering interest rates, and then again it takes a long time for the economy to respond, because once they get it moving in that downward direction, it wants to keep going in that downward direction. So, basically, we come down here, we get into this recession period over here, okay, and then for a long time we're in this recession period to uncertainty period, because basically we're at the bottom and it looks like we're trying to dig our way out. So we enter this period of uncertainty over here, and during that period of uncertainty, people aren't sure if we're out of a recession or we're slipping back into a recession, because it's usually not a straight, smooth line like this. It's usually up and down like that. That's what the reality is. So you never know that, whether you're still in a recession or whether you're coming out of a recession or you're going back into a recession. And that's usually what about 70 to 75% of the 70 to 75% of the time, this is where you're at. You're in that recession to uncertainty period, where everybody's kind of watching their nickels and dimes. Everybody's really careful not to overpay for things. People are careful about asking for too much money on things, or for pay, or for whatever. And then at some point, everybody starts realizing that, hey, we're in good times, okay? We're in good times, and then what happens is we enter this speculative period, okay, which is basically the peaks over here. We enter the speculative period, and then, again, people are like, whoa, there's lots of money flowing around out there, and everybody's racing each other to who's going to raise their prices the most, who's going to, grab as much of the pie as possible, okay? So we get into a speculative period. And then what's happening is, again, at some point the Fed comes in and they're like, okay, we have inflation starting to creep into the economy, and they start thinking about raising interest rates. Now, in this market cycle, something very different has happened. Okay, we were going along really well. We were definitely in this speculative period because everybody knew that the economy was doing well. Okay, the right thing to do would have been for the Fed to start raising interest rates to slow it down. In fact, they should have done that probably 3 years ago. The usual pattern is when you have a new president coming in, he usually wants that recession in the first year of his first term. Okay, this way he can blame the previous president, and then he's got 3 years to basically get the economy. Basically he wants this recession in his first year, and then he's got 3 years to build the economy back out, and then in his fourth year he's up for re-election. He's taking credit for moving the economy back out of the recession, and he gets reelected. And that's the usual pattern. With Trump, we saw something different. He took a gamble that he was, through his trade negotiations, he was gonna, instead of having, like, say, like an 8-year cycle, he gambled that he could have like a 12 or a 16-year cycle. Okay, so that's the gamble that he took, and it looked like it was working because he had renegotiated those trade deals. We're definitely in the speculative period, but everybody was still gambling that the market was going to keep going up. But something really unexpected happened with the coronavirus. Okay, so for the first time in my lifetime, and in the lifetime of many people, even like people who are now in their 70s and 80s, something happened to this economy that was outside of the control, because recessions are usually engineered. Okay, the way I explained. Economy gets too hot, the economy starts getting inflationary, right? Where the money starts losing its value, and the government, through the Federal Reserve, engineers a recession. Something very different happened this time. Coronavirus forced the whole country to slow down. So now we're basically kind of in a free fall, or if we're not in a free fall, we should be in a free fall. Okay, we're in a period of great uncertainty as far as what the economy is going to do. And here's the thing: look beyond. Basically, when you're in a situation like this, you really have to look beyond stock values and and economic numbers. You gotta look at production. What's actually happening. When you've got huge chunks of the population that are staying home, not working. That's a lot of people not producing things that they usually produce. Now, in our economy, the way, the shape that it had taken over the last 30 or 40 years, most of the production, or a big chunk of the production, was being done outside of the country. It was being done overseas, a lot of it in China. Okay, so what's happened as a result of this virus? Now, China is basically shut down. So by China being shut down, basically our production, all the production that we're getting, has been cut off. Okay, so now we have all these people in this country, in the United States, that are basically either keyboard pushers, right, that really don't produce anything, or they're paper shufflers. A huge chunk of the population that are staying home. But the thing is that, yeah, fine, they're staying home. They're realistically, all they do is punch numbers on a keyboard. So maybe, that's not that big of a deal. But the problem here is that all the goods that we were getting from China, that's going to, if it hasn't been shut down now, it will get shut down. Just because people over there are getting sick. And again, we don't know what's really going on in China because we can't trust any information coming out of communist China. So that's our situation. We're looking at a situation now where we got a huge chunk of our population not working. We don't know when they'll be able to go back to work, okay, when it'll be safe for them to go back to work. And likewise, we're looking at a situation where the place where we have been getting our goods from, right, from China mostly, that is uncertain. And just because they're busy, solving their own health problems over there at this point. So, and it's really difficult for us to switch our own economy over from being a mostly keyboard, keyboard punching economy over to an actual, production economy. It's really hard to make that transition in a short period of time. So when I look at the current situation, and by the way, for those of you who don't know, my background is accounting. I'm an accountant. That's what I did for, the first half of my adult life before I became a gun instructor. And I was really happy to make that change. But I do have a background in accounting and economics. So when I'm looking at this situation, I'm looking at a lot of uncertainty, and I see a lot of, we have a problem with our own people not working. We have a problem where we don't know when they're going to go back to work. And even if they could go back to work, they're not going to immediately start producing all the things that we need, because a lot of the things that we need and use are produced from outside the country, and we don't know, when and if and how certain that supply chain is going to be. So when I look at the prospects, basically I see us definitely, in terms of now, going back to the stock market, and I say stock market because that's just a way of keeping track of the economy. I easily see it going back to 1970 levels and possibly 1930 levels. When I look at the level of uncertainty, that's the only thing that makes sense. Now, as far as how I'm invested, okay, basically most of my money is in land and real estate, all right, that's just how most of it's in, about 50% in land and real estate. I have about 20% in the stock market, mostly in mutual funds, and I'm keeping it there. I'm not changing that because there's still a possibility that in 4 weeks or 5 weeks that all this virus business is over with, and basically things continue as they have been going, and this turns out to be a really short-term thing. So even though I don't believe that, for the sake of diversification, I still want to keep 20% in the market, okay? And you know what? If I end up being wrong, where we end up going back to a 1930s economy, you know what? It's not going to matter whether that money is there or not there. That's not going to make that much of a difference. If we go back to a 1930s level economy, okay? So I got 20% still in the market, which I'm going to keep there. I've got 10% cash. Okay, when I say cash, I mean either money market fund or cash in the bank, and I'm just going to keep that at that level. In case things come up where I need cash. Because like most other people at this point, there's not a whole lot of new money coming in. So I'm keeping that there. Then I'm also keeping about 10% hard cash, like hard cash, like this kind of stuff. Okay. Keeping hard cash, because if we get into a depression era, if we get us into a situation where the banks are crashing and everything's falling apart, the money in the stock market and the cash in the bank is going to be worthless. There was a situation in Europe, in Greece particularly, I don't know, I forget, maybe 8 years ago, I forget, but basically people couldn't even go to ATM machines to get money out, and in fact, at one point they couldn't get money out of the ATM machines. At other points, there were limits as to how much money they could get out of the ATMs, and this is their own money. This is their own money that they had deposited. There were limits on how much they could pull out. So that's why I want to keep hard cash on hand, especially in the black market that might develop. I want to have that hard cash, and here's what's going to happen: the money in the bank, is going to basically lose value, which means any hard cash that you have will naturally appreciate. Okay, now that's only going to go so far if we get into that 1930s level economy. If things get as bad as they might potentially get, where society does start breaking down, I'm keeping 10% in guns and ammo, and basically, as you guys know from watching some of my videos, I have farmland. So, I'm also invested, obviously, in farmland and farm equipment, so I can grow some food, and I got chickens and, that kind of stuff. So I definitely need the guns and ammo to protect my livestock and my crops, but also I want to have not just enough guns and ammo for my personal protection, but I also want to have enough guns and ammo for trade, okay? Because if I do need some goods, or if I do need some services at that point where you know the stock, where the markets, the banks, you know, where all those things have basically disintegrated. You know, the only common currency that we will have that means something to everybody, and is you know, is something that you can easily carry and trade, is ammunition. Okay, ammunition. You know, you can carry. You know, 1,000 rounds. You know, weighs about, you know, 1,000 rounds of let's say 223 weighs about 25 pounds. You can carry that in an ammo can. You know, you can throw, let's say, 100 rounds in a purse. You know, so ammunition is a form of currency. It will be a very valuable form of currency in a situation where the entire economy disintegrates. So that's why I want to have at least 10% of my you know, my net worth, let's say, in guns and ammunition, specifically ammunition, because the guns you really don't want to get rid of. Basically, if I'm going to trade a gun, I want to get like a tractor or a truck out of it, okay? But for other things, you know, because remember, the guns and the ammo will appreciate in value at that point. So guns you trade for trucks, tractors, you know, production equipment, okay? Ammunition you trade for, you know, things that, you know, like, you know, let's say you need a shovel, here's 2 bullets, you need a generator, you know, okay, fine, here's 4 bullets. You know, you need, let's say, whatever, you need 300 gallons of oil, okay, fine, here's 50 bullets, you know. So that's your currency if the economy disintegrates. So those are some of my ideas. You know, a couple of things for you guys to think about of how you want to position yourself going forward. And it kind of might be a little late. I mean, you're kind of going into this with whatever situation you have, but at the very least, you know, I mean, at this point, it's really hard to change your gun and ammo situation because, you know, it's hard to buy guns and ammo at this point. But at the very least, you can still pull money out of the bank. You know, basically, you can basically switch some of the money in the bank into hard cash, like actually make some withdrawals. You know, maybe run up, let your credit cards run up a little bit at this point, and keep the cash and withdraw it, and actually keep some hard cash in your house. And I saw, you know, at one point I had a landscaping business, and you know, basically as part of the landscaping business that I had a snow plowing service. Okay, now, when I had the snow plowing service that I was running, you know, every once in a while we would get a snowstorm that would drop, let's say, like 3 feet of snow or something. Okay, so I had this huge truck, you know, with a F550 big plow blade, and only a big truck like that can plow a lot of the. Because in the area that I'm in, some of the driveways are like 100 feet long. Okay, so when I would get like 3 feet of snow, and I would get calls for people that needed service, and here's the thing with 100-foot driveways with 3 feet of snow, I'm not charging $25 and $35. I'm charging $500, $600, you know, for those kind of driveways. Okay, so you know, I get the calls. People would tell me, yeah, I got a 100-foot driveway, you know, 3 feet of snow. I would say $600 cash. Okay, because, you know, in that type of situation, I'm not taking credit cards. You know, I'm not taking checks, because I don't know these people, and I've done business with them before. You know, if I put on a credit, you know, if I take a credit card, they might dispute it. They might, because, you know, they might say I didn't do a good enough job or whatever. So in that type of a situation, in an emergency situation, I'm only taking cash. Okay, and what would happen is a lot of people would call me up and they say, listen, you know, I got a ton of money in the bank, but you know, I don't have any cash in the house. And I'm like, you know what? I'll call you back. You know, meanwhile the phone's ringing. I'm servicing the people who have cash first. Okay. You know, cash is king. Okay, so when I got people calling me, and some people have checks and some people have cash, I'm taking the cash customers first. So that's something for you guys to keep in mind. I hope this is helpful to you guys. I don't mean to come across as a jerk, okay? But I'm trying to give you guys some useful advice for an emergency situation, and especially when I was in the snow plowing business, okay? You know, I saw a lot of emergency situations where people trapped in their houses, okay? And you gotta have cash in a situation like that. If you guys like this video, give it a thumbs up. You know, if not a member of the channel, subscribe. I'll talk to you guys soon.